Good day. Thank you for joining me. My name's Warren Davison, and I'm a Senior Analyst for the Offshore Fund Solutions. Looking at a macro backdrop, the global economic recovery continued in July, with the vaccine rollout making steady progress and restrictions on the activity being eased further in several major developed markets. Sentiment was dented, however, by the spread of the more contagious Delta variant of COVID-19, raising concerns that the path to normality may be bumpier than previously expected. Looking across asset classes, moves in the bond market were most eye-catching, as US 10-year Treasury yields continued their recent decline, falling below 1.2% during the month. Global bonds delivered 1.3% over the course of July. Equity markets took their cues from the bond market, with growth stocks benefiting from the decline in yields and returned 2.9%, while value stocks returned 0.7%. Emerging market equities lagged, returning negative 6.7%, dragged down by the weak performance from China, where announcements of tighter regulation for several sectors triggered a sharp decline in stock prices. Looking at the PSG Wealth global portfolios, on a month-on-month basis, I've shown the growth in AUM for our offshore solutions, and as you can see for July, we saw further support for the solutions, with the global creator and global flexible still leading the way. Looking at our peer group rankings, these remain strong across the board, with the longer term numbers still being dominated by first and second quartile performance. Looking over the relevant investment holding period, we can see that 4 of the 6 funds have in fact produced an average and above performance. Turning to some of the shorter term highlights. Over the 1 month, we saw quite a mixed bag within our funds, with quality stocks being favoured across the board. For the PSG risk radar, 1 fund appeared on the list this month. The 91 Global Multi-Asset Income Fund remains on the radar for both the Global Preserver Dollar class and Pound class. The reason for this is their equity component within the fund still remains hedged, and with the rising market that we've seen as of late, this has detracted from the relative performance. Turning now to the individual fund performance. The Global Preserver had a difficult month, lagging the peers by 51 basis points in the dollar class and 124 basis points in the pound class. The past 3 months have been a difficult one to navigate in the lower equity space as managers try position for the longer term. Balancing capital growth and income remains the focus, and therefore dividend yielding stocks are more favoured within this portfolio. This, however, was not favoured by market participants, as this area has been impacted by the growth over value trade reasserting itself in the latter half of quarter 2. This acted as a headwind. Within the fixed income sector, sovereign bonds remained flat over the past quarter, but elsewhere, credit exposure was additive to returns as spreads compressed further. For the global moderate, we saw a positive month, with the fund generating 74 basis points of absolute return. However, it did lag the peer group by 23 basis points. Over the month, we saw strong contributions from most managers. However, 2 of the more growth-orientated managers, T. Rowe Price and BlackRock, interestingly lagged. The fund has seen an interesting mix within underlying managers, each providing complementary returns during difficult market shifts. Capital Group and Ned Group have been our positive excess return generators over the 3-month period as fixed income has improved as well as market breadth increased. The Global Flexible saw another strong month for both the USD and GBP class, each outperforming the sector over the month. We saw the first quartile performance from Royal London and MFS Prudent Capital, which is surprising given their significant difference in asset allocation. Growth in equities remains favourable, however, stock selection remains increasingly more important in a time like this as US markets are reaching all-time highs. The Global Creator also saw a strong performance, with the month delivering 106 basis points of outperformance. Fundsmith, Goldman Sachs and Ned Group were our 3 strongest managers, as quality was the driving theme. With the strong pullback in China shares, we saw T. Rowe Price underperform over the month due to their higher Asian allocation. The balance of managers remains complementary, however, during these turbulent markets. Overall, we can see that PSG Multi-Management is still achieving their 3-pillar approach of consistent above-average performance at below-average risk while maintaining a competitive price. Thank you. Please take note of the following disclaimer, and if you do have any questions, please feel free to reach out to us.